Right. Wonderful. So this is Boom 500. And if ever you're in the signals group, you just saw that we gave a sell. I just want to show you how we are selling. Why we are selling now. Why we are selling now is because of the analysis that I'm just going to do right now, real quick. Right. So on the daily, you can see on the daily time frame, you can see that this was a retracement, this was a continuation. This also is also a retracement because it hasn't broken this swing high there. So long we haven't broken a swing high, we still consider whatever move that is there as a retracement. This swing high there, that's a daily swing high. So that's a daily swing high. So long it hasn't been broken, it means that move that has been happening is simply a retracement. And also it means we'll still be in an overall bearish order flow overall. Right. So that's a daily swing high. That's a daily swing high there. Right. So that's the first point. Where is our swing low? Our swing low is here at the bottom here. And if we're in a bearish market, you know that we always move from a swing high to a swing low. For example, here once we create a lower high there, we're going to come and take out this daily swing low here. Daily swing low. Swing low. Right. So those are the two major zones that I have. Right. Then another thing that you also must be very good at is identifying key zones. Key zones, those are your normal support and resistance levels. We are simply looking for a zone that was tested quite a number of times by the market. If you look to the left here, you can see where I just placed you can see that this is a zone. This is a zone, key zone. It's a key zone from the past there. You can actually see that it's a key zone, which is almost roughly where this market is. Can you see the key zone? We started here. So a key zone is simply a zone that was respected most of the times. Like if you check here, respected, 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 respected here. So it qualifies to be a key zone. Key zone. So the market will always either it will come and reject on a key zone, or it will come and respect a key zone. That's the nature of. So key zones, there are so many different kinds of key zones. Supply and demand, it's also a form of a key zone. Order blocks are a form of a key zone. Even your Fibonacci retracement level, sometimes they're also a form of key zones. So key zones, they come in different ways. So I can see that the market is on my key zone, number one. Number two, I can also see that we have a Fibonacci retracement 88%. Right, I have two major points right now. Number three, you can see that overall we are still in an overall bearish order flow market. Why? Because this is a lower high, lower low. This is a lower low. So here we are trying to create a lower high. So meaning if ever this market, if ever it reverses from here, this is going to be our lower high. That being our lower high, it means our major target will be the low, which is that lower low there. Right. So after we have identified now we're at a key zone, we're also at we are also at a Fibonacci retracement level. Right. So now you can also include other confluences. Remember, the more the number of confluences that you have on a trade, the higher the probability of that trade winning, or the you actually your probabilities of winning on that particular trade that you'll be in, they are higher than just someone with lesser confluences on a trade. So what we're simply doing now is simply wanting to identify other confluences that we can look for on that particular trade, right? Here at the bottom, you can see that this is a trend line. Trend line there at the bottom was being respected. As you can see, we can also try to draw a trend line at the top there. You can see we also have a trend line at the top here, which is this one. Touch there, touch there, touch there. So we have a trend line there. We have a trend line there. It seems like it's a trend line as well. It touched here. It touched here, or let me try to refine it to this so that it touches, yeah. First touch, second touch here, third touch there. So once you have first touch, second touch, you stretch like that. First touch, second touch, you stretch. So we also have a trend line at the top and a trend line at the bottom. Key zone, trend line, Fibonacci retracement. Those are some of the confluences that we are having already. And according to simple basic understanding, you know that once we're at the top of a channel like that, we expect the market to drop to the bottom of the channel. Maybe if it wants to continue up, it will continue up. So this is the first basic understanding. So if it breaks there now, that's where maybe we expect a break and retest, then all the way like that. So this is the basic understanding. So us going down to lower time frames now, going down to 4 hour, we're simply going down there to identify more confluences that we might not be seeing on the daily. If there's any confluence that we are not seeing on the daily, that can also help us. So now, 4 hour time frame. 4 hour time frame, let's look at what is going on. Right. What is going on the 4 hour time frame? It seems like we have some form of a double top. Double top. Here we have a top. Here we also have another top. So meaning, if ever this market fails to break this high, which is this high here, which is also where the key zone is. If we fail to break there, it means we have a double top. And as far as you know, as far as we have gone through with the course, you know that a double top is simply a reversal pattern. Before a market reverses, for example, in this case, it was going up for a very long time, and before it reverses to start coming down, we have to create a reversal pattern. Reversal patterns, they come in different forms. Double top is one of them. A double top is an example of a reversal pattern. If you notice, let me just look for simple examples here. Right, if you notice here, this market was going up. Okay, even before it reached that top there, you realize that here we formed a double bottom, then we went up. Right? Here, this was a form of a double top, even though it was not as accurate, but it was a double top. Double top, we went down, double bottom, we went up. This, I'm not saying that if ever you see a double top anyway, you just sell, or if you see a double bottom anyway, you just buy. No. You combine it with further confluences, then you, for example, this is a double bottom. Once you have those other confluences, it means you can now combine that as an extra confluence. You can just combine that as an extra confluence. You can see all these double bottoms, double tops everywhere. So these are simply reversal patterns. These are simply reversal patterns. Double bottom went up, double top went down. So you see everywhere you can see. So I'm saying here where we are, if it fails to break this high, right, we'll be having a double top, and it's also in a key zone. It's also in a on a Fibonacci retracement zone as well, right? So it will be, once it's a double top like that, you know that a double top, your first zone that you expect to be broken is the neckline, which is here. The neckline of that double top, which is here, right? Once the neckline is reached and it's broken, you know that we are just continuing to go down, right? That's a basic understanding. That's a basic understanding. Now, so I now have more details on the 4 hour. Those are more details that I now have on the 4 hour. Let's see if I can draw another channel on the 4 hour, if I can draw another trend line. If ever there's any other trend line that you can draw on the let's see. Right, you can see that this is also some kind of a trend line. Touch, 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 touch. It's a trend line as well. Meaning it can also be used as an entry criteria somewhere, somehow. It can also be used as an entry criteria once it's broken like that. So this is a trend line you can see as well. So on 4 hour, I think we now have extra details. We have a double top, we have a trend line. So let's go down to 1 hour, 30 minutes, and even 15 minutes. Let's see if ever we can get extra and more confluences, extra and more confluences. Right, so this is 1 hour, 1 hour time frame, right? Right, 1 hour time frame, and I said with the high there, which is this one. So this high, so long it's not broken, the market can even come, temper with it, close below, it's not broken, right? So now, that's point number 1. Point number 2 is we have established an internal change of character now. We have established an internal change of character. Internal change of character. How do I know that we have established an internal change of character? If we look to internal structure, if you look at internal structure, we're going high, higher, high, higher, low, higher, high, higher, low, higher, high, higher. This is internal structure. Right. So our latest higher low was this one. If ever we break a higher low like that, it means that's a change of character. Once it's a change of character, it means order flow has shifted from bullish to bearish. So what you know that is that after every change of character like this, we expect a pullback. Pullback where? Let me just remove this, or let me hide it. Let me hide that. We expect a pullback into either an order block, a supply that was left behind, or at most sometimes it comes all the way to test that high. Test that high, that changed character there. Right, so here we have a supply. You can see this is a supply, which is where we currently are in sales right now. We currently are in sales because we have a supply, and we also have this high here that established this internal character. So now, according to that, it means our target now, our target from here where we are, our first target would be this. Because remember, if ever order flow is now bearish, like what we have seen there, if our order flow is now like that, it means we're going to move in something like this. We'll come, we'll break structure, we pull back into any order block or supply. We continue, we break structure. That is bearish order flow. That is bearish order flow. That will be bearish order flow. So it won't go down in a straight line. Someone who might think that it will go down in a straight line. The same way it was coming up, it wasn't even coming up in a straight line. It was moving up, giving retracements, go up, retrace, go up, retrace, break structure, retrace, break structure, retrace, break structure, retrace. That same pattern going up is the same pattern that you see coming down. So from here, our first target is this one. You expect this one to be broken. Once it breaks that structure, so someone who might want a short-term target, you can target this. But obviously, personally, I'm anticipating this to be a long-term trade, which is going all the way. Remember the target that I showed you on the daily. That's personally the target that I'm targeting personally. And also you can even use this trend line if ever you want a reasonable, you can use this trend line, right? So it can do something like this: break structure, pull back, break structure, pull back, up until it touches your trend line. So this you can use this trend line as well as your first reasonable target if you don't want to hold all the way down there, right? So if it comes all the way to break structure there, you can as well shift your stop loss into profits here. For example, here right now, according to what we are seeing right now, your stop loss, you can simply put it just above the trend line there, which is just above here, right? Like this, right? This is your first target, first reasonable target. First reasonable target is there, but overall, we're expecting even this trend line, right? Right. So let me just return it back here. So now, once we come into this and break structure there, once we come to break structure there, you can shift your stop loss, which was here, either to break even, or you can even put it into profit, right? You can even put it to profit or break even. That is if you want to hold this trade for a very long time. Holding for a very long time, it also has its own advantages because you get to benefit out of the full move in a market. A full move is when the market establishes a full rotation. For example, if we're coming from a major, let's say major lower high, right? If we're coming from a major high, for example, in this case, if we're going up, it's when you're coming from a low, then we establish this high. This is a full move before a retracement, right? So same thing coming down, it's like when you're coming from this lower high to this lower low. That's a full move. So that's the full move that we're expecting. What we saw on the daily, what you saw on the daily, it will be coming from a lower high, major lower high, to take out that major lower low, right? That's a full move. So someone who will be, so if ever you also want to maximize profits, you also can be trailing your stop loss. As the market will be moving, comes here, break structure, you can trail your stop loss even all the way above here. It's also fine because if it keeps on going before retracing, you know that you actually make profit out of that. So there are so many ways to navigate or to go about it if ever you just want to. Unlike the worst thing that you can do is to come out of a trade, is to come out of a position, especially after analysis has been done, projections have been made, after we have analyzed everything like this. The worst thing that you can do is to come out of a trade anyway, just randomly, for no reason. I always tell people that you don't, the same way we enter is the same way we come out. If we enter based on confluence, you must also come out based on confluence. If we enter a trade based on certain confluences, coming out of the trade, you must also come out based on confluence. You don't just come out because you feel like coming out. No, you come out also because of confluence. So right now, where it is, I gave the sell signal already. Which is fine. Because if you go down to 15 minutes, that's my last time frame when it comes to analyzing or even entering, right? So you can see the high there, right? You can see the high there. It hasn't been broken, so it means we are still safe. So now on 15 minutes, you can see some form of a double top. You can see some form of a double top here. This is a double top there. You can see also a double top to the left here. These double top formations, you always see them double top here. Went down. Those are reversal patterns. Before the market comes down, it will form something like that. Same thing here that I'm seeing already. I can see some form of a double top, which is here. Something it's too tight, but you can see somehow that it's a double top trying to form there. Right. So that is it. That is the entry. That is the first target there that we are targeting. So I think for this particular trade, this is everything that this is everything that I can see. This is everything that I can share with you guys. If ever you have any question, feel free to ask before we move on to the next instrument or the next pair. Anyone with a question? Anyone with a question? Is it clear?
Yes, it is.
Wonderful, wonderful, wonderful. I think silence means people they've understood. So that one, we are done. We are done, we are done, we are done, we are done, we are done completely. Let me now go to this interesting pair, which is gold. Hey, no. Right. So gold, I have a setup already, but let me see if I can open a new chart. I can't delete this analysis. So tomorrow it's NFP for those that know NFP. If you don't know what NFP is, NFP it simply stands for non-farm payroll. Non-farm payroll. This is an economic news that is released monthly, every Friday, every Friday of every Friday every month. It's an economic news that is released in America. It simply stands for jobs that were created that are non-farm related, new jobs that were created that are non-farm related. So just a basic understanding of NFP, it means if ever, for example, you find it in a form like this. Let me just open something real quick. That's where you get the news there. Either you go to Forex Factory, you go to investing.com, all of those, they can actually show you the news. They can actually show you the news event, the result of the news. So it's tomorrow. Tomorrow it's the 4th of August. Let me see. Thursday, Friday, tomorrow, Friday. This is Friday. Right. Let me see. Where is it? Where is it? Where is NFP? Where is NFP? I don't know why it's not appearing here. Let me try to refresh my screen. Well, let me go to investing.com. Investing.com. Right. So this is tomorrow, Friday, August 4. So these are the news events that are going to be tomorrow, right? For someone who doesn't know how this operates, right? These are the news events that are going to be there tomorrow. The ones that are in red, I call them the major news that are going to have high impact on the price, right? The ones that are the ones that have a red color here, those are the ones that will produce high impact or high movements on the market. So everything else that is not red, it might not produce that high movements or those volatile movements. So it's tomorrow 2:30. This is the news. NFP. This is non-farm employment change. So it can also be called non-farm payroll. So it can be written so many names, but so now how they write it in. So there are two things now. What is this? There are two things to take note of. There are two things to take note of. There are two things to take note of, right? There is this unemployment rate, and there's this non-farm employment change. These are the two most important things, right? non-farm employment change, and the unemployment rate. The unemployment rate, previously, it was 3.6%, right? It was 3.6%, and right now, their projection of tomorrow is also 3.6%, right? This is the unemployment rate. So it means now, if the unemployment rate tomorrow, if it comes higher than 3.6%, it means it's greater than this, right? If the unemployment rate is greater, is greater, it means that is negative news for the dollar. That is negative news for the dollar. If it's negative news for the dollar, it means let me go down to let me have a whiteboard real quick. If it's greater than 3.6%, right? It means the unemployment rate is greater. If the unemployment rate is greater, it means now that it's negative for the dollar, means the dollar must go down, right? If the dollar must go down, it means all the pairs that start with the US dollar like this, whether be it USD ZAR, USD JPY, USD JPY, these ones, they're going to drop, right? And all the pairs that end with the US dollar, which is your gold is XAU, USD. These ones, they'll go up. What else? GBP USD. Will go up. US30 USD. It will also go up. So this is how news happens. Once it's released like that, what you simply do, you just look at the pair that you're trading, right? You look at the pair that you're trading and you look at the news. For example, here I just gave you an example. Unemployment rate, if it's greater than 3.6%, the dollar is going to drop. Same thing here, non-farm employment change. It also means, so this one, it's simply a figure now. This one comes in percentage, but this one is a figure. This one, it simply means previously, which was last month, there were 209,000 new jobs that were introduced in the United States that were non-farm related, right? Now, this month, which is the month of August, they're expecting 205,000, right? It means if ever they get a higher figure than that one, what does that mean? It means more jobs. And if it's more, it's positive now. It's more jobs, it's positive for the dollar, means the dollar must go up. So most of the times these two they go hand in hand. You realize that this one, if it's less jobs, it means this one will be higher. If this is less jobs, it means the unemployment rate will be higher. So you just look at the numbers, and after looking at the numbers, you must come up with a conclusion. If they're expecting 205,000 new jobs to be introduced, and if it's this is positive for the dollar. If it's 205,000, it's positive. If it's greater than 205,000, it's also positive. If it's less than 205,000, it's negative. The dollar will drop. So that is just a rough idea of what NFP is and of how we trade NFP. We simply analyze data. Once we analyze data, we actually look for the entries based on that data. So, for example, on gold, I have a simple setup. This is a simple setup that I have on gold. I think we did an analysis already. This one, if you notice our previous videos, we actually analyzed gold, and according to our prediction, we predicted this drop. We predicted this drop from this supply, right? This was the 4-hour supply that led to the drop, which was this drop. Break of structure here, pull back into a supply, then drop. So now we have a demand that is here, where I'm expecting the market to go up from, which is actually the move that I'm expecting tomorrow. Tomorrow, it's simply I'm expecting buys all the way on gold. So I'm expecting the market to come here, come above, then we continue going higher. So tomorrow, it's simply I'm expecting buys, but we'll just analyze the data and we'll see what the data will be saying. But tomorrow, if ever the data is in our favor, it will just have followed this. It would have just followed this analysis. It would have just followed this analysis. So that is what is going to be happening tomorrow. NFP. So I think everyone understood based on what we've just explained now. Anyone with the question?
Michael, I have a
Yes.
question.
Yes, Mr. Tristan.
So we start from the 24-hour to the 4-hour to the 1 hour, right?
Yes, you can even start from the weekly.
Yes, you can even start from the weekly. What is the main difference between the 4-hour and the 1 hour? I don't understand that quite well.
The difference is the amount of time that it takes for the candle to close and the candle to open. Like these candles, right? If it's 1 hour time frame, it means it takes 1 hour for each and every single candle to form.
Yes, of course.
If it's the daily, it means each and every single candle, it's 1 day. It's 1 day old. It takes 1 day, 1 day, 1 day, 1 day for each and every single candle to form and close. So it's all in the difference of the difference is simply how much time it takes for the candles to open and to close. That's roughly the major difference between these higher time frames and
And how do you approach that in your analysis then?
is you just do a top-down analysis. Top-down analysis, you're simply starting from the higher time frame. The higher time frame, this gives you the overall picture. The purpose of lower time frames is so that number one, remember, you are day traders and you also swing trade, right? And you're not what we call position traders. Position traders, they are people that can hold trades for months. Those guys they don't need to go down to 4 hour, 1 hour. Those guys can analyze daily, weekly, and monthly. They are fine. They just go there, they do their analysis. Once they do their analysis, they enter their trade on those higher time frames. Why? Because even the monies that the equities that they will be trading, they actually permit them to do that. But now your purpose of going down to a lower time frame is so that you get accurate entries and also smaller stop losses on each and every single entry that you're going to enter.
Okay, thank you.
Wonderful. Anyone else? Anyone
Also,
else?
a question. Can you hear me?
Yes.
Okay. So I want to ask, when it comes to currencies, and like
Yes.
you're saying, for example, when there's a day where there's news, right? And then
Yes.
let's say you are in a setup, let's say you're in gold, and you are, let's say, in a buy position. And
Mhm.
then when it's time for news, probably let's say it wants to go to sell. Like, do you exit that trade or you hold it? Or how do you approach, let's say, the current trades that you'll be in and there's news on that day? Like, do you have to exit the trades or you just leave it like that?
Right. There's what we call for example, when there's news comes with too much volatility. Sometimes they can cause gaps on the market. Like let's say candles are forming nicely like this, like this, like this. Then you find a gap, like a gap here, then you find something like this. So it can affect you now if you're in a trade. If you're in a trade already, right? If you're in a trade already, it can affect you. That's why it's wise if ever there's news, you can close your positions before the news. That is, let's say you are not aware of what is happening or what might happen as well. For safety, you can simply come out of those positions. Then if ever you've analyzed news and your data and everything, if ever it's in line with what you're in already, there's no need for you to come out. I don't know if I'm making sense.
Yes.
Okay. Anyone else with a question? before we close. So tomorrow, guys,
Hi, sorry.
yes,
I wanted to find out, I'm not sure if I missed it, but had you done an analysis of US 30?
US 30, let me see. US 30, we did an analysis in the previous Zoom sessions that we did. I think we
Sorry, I missed
analyzed,
it.
I think we analyzed this. Let me see. I think I'll just do another analysis video. Just do it just now and put it on the YouTube channel. Then you see it there. You see it there. I'll just do it now real quick. Then you'll see the analysis there. But I think we discussed about US 30. We discussed even this 4 here. We talked about the 4 here. But it's fine. I'll do a video real quick